In the world of real estate analysis, there is a prevailing narrative that capital only flows in one direction: south. For the better part of the last decade, the headlines have been dominated by the Sun Belt boom, characterized by massive migration to Florida, Texas, and Tennessee. But in the current economic cycle, as interest rates stabilize at higher levels and insurance premiums in coastal regions decouple from reality, a quiet but powerful countertrend has emerged. Sophisticated capital and high-income households are beginning to rotate out of high-beta growth markets and into low-volatility value markets. And sitting at the epicenter of this shift is the Commonwealth of Pennsylvania. What we are witnessing is not a frenzy of speculation, but a calculated flight to quality. While transaction volumes in the hottest markets of the pandemic era have cratered, Pennsylvania is seeing a resilient influx of new residents. These are not just retirees looking for cheaper taxes. They are prime-age workers, remote professionals, and investors seeking a hedge against the volatility plaguing the rest of the nation. The market here is sending a signal that boring is beautiful. In an era of economic uncertainty, the stability of the Pennsylvania housing market, anchored by diverse industries and historic affordability, has become its greatest asset. This migration phenomenon is driving a fundamental repricing of the state's real estate assets. We are seeing neighborhoods that were stagnant for 20 years suddenly experiencing multiple offer scenarios. We are seeing inventory absorption rates that defy the national slowdown. If you are looking to understand where the smart money is hiding in this cycle, you need to look at the Keystone State. But there is a specific financial mechanism driving this migration that goes beyond simple affordability. It involves a tax arbitrage strategy that high-net-worth individuals from New York and New Jersey are using to effectively increase their take-home pay by 15% simply by crossing the Delaware River. In the second half of this report, we will break down exactly how this math works and which specific counties are the primary beneficiaries. The volatility arbitrage. To understand why people are moving to Pennsylvania right now, we must first analyze what they are moving away from. During the previous cycle, buyers flocked to high-growth markets like Austin and Phoenix. These markets offered massive appreciation potential, but they also came with massive volatility risk. When the market turned, those areas saw prices correct sharply. Pennsylvania, by contrast, operates on a different frequency. It is a low-volatility asset class. When the national market boomed by 40%, Pennsylvania appreciated by a steady, sustainable 15 to 20%. Conversely, when the national market corrects, Pennsylvania tends to hold its value. Buyers in the current climate are prioritizing capital preservation over speculative growth. They are looking at the charts and realizing that a home in the Philadelphia suburbs or the Pittsburgh metro area acts as a defensive anchor in their portfolio. They are moving here because the downside risk is mathematically limited compared to the boomtowns of the South and West. This safety premium is attracting a more sophisticated, risk-averse demographic that values stability over hype. However, stability is only one part of the equation. The other driver is a looming crisis in the insurance markets of coastal states. We are seeing a wave of climate migrants moving to Pennsylvania not because of the weather, but because it is one of the few remaining regions where property insurance is both available and affordable. This insurability premium is about to become a major valuation factor. The affordability moat. The primary engine of this migration remains the affordability moat. In a high-interest rate environment, the cost of capital is the single biggest barrier to entry. When mortgage rates hover around 7%, the purchasing power of the average buyer is slashed by nearly 40% compared to the pre-cycle peak. In high-cost markets like New York, Boston, or Washington, D.C., this rate hike has made homeownership mathematically impossible for even the upper middle class. A household earning $200,000 a year can no longer afford a median-priced home in those metros without becoming house poor. Pennsylvania offers a release valve for this pressure. The median home price in the state remains significantly below the national average, and vastly below the Northeast Corridor average. A buyer can sell a cramped, two-bedroom condo in northern New Jersey, move 90 minutes west into Pennsylvania, and purchase a four-bedroom single-family home on an acre of land, while simultaneously lowering their monthly debt service. This is geo-arbitrage in its purest form. Buyers are exploiting the price inefficiency between markets. They are keeping their high salaries, thanks to hybrid work policies, but adopting a low cost of living zip code. This influx of high earners is creating a wealth effect in local economies, supporting local businesses and driving demand for premium services, which in turn supports property values. Now that you understand how the mathematics of affordability and volatility are driving buyers across the border, you must see how the state's unique geography amplifies this trend. The next section will explore the logistics advantage, why Pennsylvania's location is making it the logistics capital of the East Coast, and how that industrial boom is fueling residential demand in unexpected places. The Keystone geography. Pennsylvania isn't just cheap, it is strategic. The state sits within a day's drive of 40% of the U.S. population. As the global supply chain reorganizes and onshoring becomes a national priority, Pennsylvania has emerged as a critical logistics hub. We are seeing massive investment in industrial real estate along the I-78 and I-81 corridors. This industrial boom creates jobs, but not the steel mill jobs of the past. These are modern logistics, engineering, and management roles. This job growth creates organic housing demand. People are moving to Pennsylvania not just to commute to New York, but to work in the rapidly expanding local economy. Investors need to pay attention to where these logistics hubs are being built. There is a direct correlation between industrial square footage absorption and residential rent growth in the surrounding 5-mile radius. The workers filling these massive distribution centers need housing, and currently, the supply is insufficient. But while industrial growth is strong, there is a shadow risk in the Pennsylvania market that few are discussing. It involves the aging housing stock and the massive capital expenditures required to modernize it. In Part 3, we will discuss why buying a historic charm home in the state can sometimes be a financial death trap. If the logistics boom is providing the blue-collar bedrock for Pennsylvania's resurgence, the next driver is providing the white-collar ceiling. We are shifting our focus to the sectors that have effectively insulated the state from the broader volatility of the tech recession: healthcare and education. In economic circles, this is known as the meds and EDS thesis, and in Pennsylvania, it is the primary engine of wealth retention. The recession-proof economy. Unlike California or Texas, which are heavily exposed to the cyclical swings of the technology and energy sectors, Pennsylvania's economy is anchored by massive, institutional employers that are largely recession-proof. The University of Pennsylvania, UPMC in Pittsburgh, and the massive health networks of the Lehigh Valley are the state's largest employers. This matters for the housing market because it provides income stability. When a household feels secure in their employment, they are more likely to buy a home, renovate a kitchen, or invest in a rental property. The layoff anxiety that is currently freezing transaction volume in the Bay Area or Seattle simply does not exist to the same degree in Philadelphia or Pittsburgh. This stability attracts a specific type of migrant, the risk-averse professional. We are seeing doctors, researchers, and academics relocating to Pennsylvania because the income-to-housing cost ratio is among the best in the developed world. A surgeon in Pittsburgh can buy a mansion for the price of a starter home in Boston. This surplus income flows back into the local economy, creating a multiplier effect that supports high-end retail, dining, and services, further increasing the desirability of the neighborhoods surrounding these institutions. For real estate investors, the strategy here is obvious: follow the scrubs. Neighborhoods within a 15-minute commute of major hospital systems or university campuses are seeing consistent appreciation and virtually zero vacancy in the rental market. These are the blue-chip zones of the state. But while the meds and EDS sectors provide stability, there is a hidden inflation risk associated with them. These nonprofit institutions often do not pay property taxes, which shifts the tax burden onto residential homeowners. In the final section, we will discuss how to identify which municipalities are most at risk of a property tax hike due to this imbalance. The rise of the secondary cities. The most fascinating trend in the current Pennsylvania migration is not the growth of Philadelphia or Pittsburgh, but the explosive rise of the secondary cities. Places like Allentown, Bethlehem, Lancaster, and Reading are experiencing a renaissance that defies the national narrative of urban decline. For decades, these were industrial towns struggling with an identity crisis. Today, they are lifestyle hubs. They offer walkable downtowns, historic architecture, and a strong sense of community, all at a price point that makes home ownership accessible to the median earner. This resurgence is being driven by the hybrid work model. A worker who only needs to be in New York City or Philadelphia once a week does not need to live in the expensive inner suburbs. They can move 60 to 90 minutes out, to a place like Lancaster, and get a higher quality of life. The train connections and highway infrastructure make this supercommuting viable. We are seeing a massive influx of equity refugees from the tri-state area cashing out their appreciation and buying into these secondary markets all cash. This cash injection is driving gentrification at a rapid pace. Home prices in the Lehigh Valley have outperformed the national average significantly over the last 12 months. This is value discovery. The market is realizing that these towns were undervalued for 30 years, and it is correcting that pricing error in real time. Now that you understand how secondary cities are absorbing the overflow of demand, you must see how this migration creates a specific opportunity for value-add investors. The housing stock in these towns is old, very old, and this aging inventory is creating a massive gap between the price of unrenovated homes and turnkey product. The renovation premium. Pennsylvania has some of the oldest housing stock in the United States. In many of these booming secondary cities, the average home was built before 1950. This creates a unique market dynamic. The new demographic moving in, younger, busy professionals, does not have the time, skill, or desire to manage complex renovations. They want turnkey luxury. This preference has created a massive spread between as-is value and after-repair value. We are seeing renovated row homes in Lancaster selling for premiums that shock the local appraisers. Investors who can successfully navigate the renovation process, dealing with the old wiring, the slate roofs, and the historic preservation boards, are seeing outsized returns. However, this is also where the risk lies. Old house problems can destroy a budget. But for those who get it right, they are supplying the exact product the market is screaming for: modern amenities in a historic shell. But there is a trap here for the inexperienced investor. Many of these historic properties come with hidden liabilities that don't show up on a standard inspection. We are seeing a rise in sewer lateral failures in these older towns, a repair that can cost $15,000 or more. Later in this report, we will tell you exactly what inspections you must demand before closing on a Pennsylvania property. If the renovation premium represents the microeconomic opportunity in Pennsylvania, the next driver represents the macroeconomic tailwind. We are talking about the massive injection of federal and state capital into the region's infrastructure. Pennsylvania is currently a primary beneficiary of the federal infrastructure bills, and this spending is reshaping the map of where value lies. The infrastructure renaissance. For decades, Pennsylvania's infrastructure, its bridges, highways, and rail lines, was a punchline. It was aging, crumbling, and inefficient. But in the current cycle, billions of dollars are flowing into the state to fix it. We are seeing major upgrades to the I-95 corridor, the expansion of regional rail services, and the revitalization of key bridges. Why does this matter to a real estate investor? Because access creates value. When a commute time is cut by 15 minutes due to a highway expansion, or when a new train station opens up access to a previously isolated town, property values in that catchment area re-rate immediately. We are seeing this play out in real time along the Schuylkill River Trail and the expansion zones of the SEPTA Regional Rail. Towns that were once considered too far out are now just close enough. Smart money investors are front-running these projects. They are buying land and multifamily assets in towns slated for infrastructure upgrades, knowing that connectivity is the precursor to gentrification. This is a long-term play, but it is one backed by the certainty of government spending contracts. But infrastructure isn't just about roads. It's about energy. Pennsylvania sits atop the Marcellus Shale, one of the world's largest natural gas reserves. With global energy security becoming a priority, we are seeing a quiet resurgence in the energy corridor real estate markets. This localized boom is creating rental demand in rural areas that typically see zero growth. The school district arbitrage. While infrastructure moves the masses, schools move the families. And in Pennsylvania, the school district you live in is the single most important determinant of your home's value. The state operates on a fragmented system of hundreds of small school districts, each with its own tax base and performance metrics. This creates extreme valuation cliffs. You can have two houses on opposite sides of a street, identical in size and condition, but trading for a 20% price differential simply because they fall into different school catchments. Migration into Pennsylvania is heavily driven by school arbitrage. Families are realizing they can move to a top-tier district in the Philadelphia suburbs, like Lower Merion or Radnor, and pay public school taxes instead of $40,000 a year for private school tuition in New York or D.C. Even with high property taxes, the math works in their favor. This relentless demand for blue-chip school districts acts as a floor for property prices. Even in a recession, parents will sacrifice everything else to keep their kids in a good school. This makes real estate in these specific zones a defensive asset class. It is recession-resistant equity. However, this creates a challenge for investors. The entry price in these districts is high, compressing rental yields. The play here isn't cash flow, it's appreciation and stability. It is a safe deposit box for capital. Now that you understand how school districts and infrastructure create pockets of value, you must see the final piece of the puzzle. It involves the cultural shift happening in the state. Pennsylvania is shedding its Rust Belt image and reinventing itself as an outdoor recreation capital. This shift is driving a boom in short-term rentals and vacation homes in areas that were previously ignored. The outdoor economy. The Poconos, the endless mountains, and the river valleys of Pennsylvania are experiencing a tourism renaissance. As international travel becomes more expensive and chaotic, the drive-to-vacation market is booming. Millions of people within a 3-hour radius are choosing to vacation in Pennsylvania. This has created a robust market for short-term rentals, STRs. Unlike the oversaturated beach markets of the South, the Pennsylvania STR market is still maturing. There is demand for high-quality, experience-driven cabins and lodges. Investors who can provide a boutique hotel experience in a rural setting are seeing double-digit cash-on-cash returns. But this market is sensitive. It relies on discretionary income. If the economy enters a deep recession, travel budgets are the first to be cut. Investors in this sector need to stress test their numbers. Can the property survive if occupancy drops to 40%? If the answer is no, it's a gamble, not an investment. Yet, there is a looming threat to the STR market that has nothing to do with the economy. Local municipalities across the state are beginning to crack down on Airbnb-style rentals, passing zoning ordinances that ban them entirely. In the final section, we will tell you how to identify STR-friendly zones that are legally protected from these bans. The final factor driving the Pennsylvania narrative is also the most complex: political risk. While the state offers affordability and stability, it also carries a legacy of complex governance that can trap the unwary investor. We are talking specifically about the property tax reassessment risk and the zoning crackdown sweeping through local municipalities. The tax trap. Pennsylvania's property tax system is notoriously archaic. In many counties, assessments haven't been updated in decades. This means a home might be taxed based on its value from 1990. When you buy that home for market price today, you trigger a potential spot assessment, or eventually face a county-wide reassessment that could double or triple your tax bill overnight. This is the hidden liability of Pennsylvania real estate. A property that looks like a cash flow home run can turn into a break-even deal if the taxes reset to current market value. Sophisticated investors always underwrite deals based on the future tax assessment, not the current one. If the numbers don't work at the higher tax rate, they walk away. Furthermore, the state relies heavily on local property taxes to fund schools, as we discussed in the school arbitrage section. This creates pressure on municipalities to find new revenue. We are seeing aggressive tax appeals by school districts against commercial and residential owners they believe are underassessed. This is a fiscal drag on appreciation that you must factor into your long-term hold strategy. The zoning crackdown. The other political risk is the backlash against the Airbnb economy. As the STR market boomed in the Poconos and rural counties, local residents began to push back against the hotelification of their neighborhoods. Townships that once ignored short-term rentals are now passing strict ordinances. Some are banning them entirely. Others are imposing cap limits or expensive licensing fees. For an investor who bought a cabin assuming 80% occupancy on Airbnb, a sudden ban is catastrophic. It turns an income-generating asset into a vacant second home. The smart money is moving into areas with buy-right zoning, where short-term rentals are explicitly allowed by the code, or into purpose-built resort communities that are immune to municipal bans. The days of buy a house and rent it on an app, without doing due diligence on the local politics, are over. My final thoughts. The safe haven strategy. So, why are people still moving to Pennsylvania despite these risks? Because compared to the alternatives, the risks are manageable and the upside is tangible. Pennsylvania represents a return to reality. It is a market where you can still buy a home for 3 to 4 times the median income. It is a market where the economy actually makes things and moves things. It is a market that offers insulation from the wildest swings of the national economy. For buyers, this is your window. The frenzy of the pandemic is over, but the structural demand remains. Use the current stabilization in rates to negotiate. Focus on these secondary cities where the revitalization is just beginning. Places like Lancaster or Bethlehem. Look for homes with good bones that need cosmetic updates. That is where the equity is hiding. And always check the property tax history and the school district rating. For sellers, you are holding a desirable asset, but pricing power has limits. Buyers are educated and sensitive to monthly payments. If you price your home correctly, you will sell quickly, often with multiple offers. But if you test the market with an aspirational price, you will sit. The market is efficient. Respect it. For investors, the play is defensive growth. Look for multifamily assets in the logistics corridors. Look for student housing in the stable university towns. And if you are playing the renovation game, focus on high-quality finishes that appeal to the incoming coastal migrants. They have the cash, but they demand the quality. The migration to Pennsylvania isn't a flash in the pan. It is a structural realignment. People are voting with their feet for stability, affordability, and community. The Keystone State, often overlooked, is quietly winning the long game. If you found this deep dive valuable and want to see the specific data on which Pennsylvania zip codes have the highest inbound migration ratios right now, make sure you are subscribed. Stay disciplined, do your diligence, and I'll see you in the next breakdown.